if something's a preferable form of money, you have to analyze the question from both the issuer's perspective and the user's perspective, right? So I can see why governments want to issue central bank digital currencies. It gives them greater surveillance capabilities. They can program different interest rates more easily for different regions or different groups of people, and they can freeze people's money. I mean, there's all sorts of things that they can do if they have digital retail money. Whereas from a user perspective, one of the key innovations, or one of the key things that Bitcoin brings to the table, is that the actual bearer asset can move around quickly rather than just a claim on that asset. And I think one of the downsides, so I don't agree with anything you said, but the challenge is that when you have something that relies on abstraction in order to move around efficiently, the challenge there is that it's easy to break that promise, break that peg, break that redeemability. And that's what we saw happen with literally every jurisdiction in the world. That you had the system, and I've argued that it's essentially that speed mismatch between commerce and the underlying settlement that allowed for governments and banks to be able to arbitrage that speed difference and eventually be able to break it. And when they broke it, and they had these fiat only systems, the fact that if you could just teleport gold around and between people like mentally, right, it'd be really hard for fiat currencies to develop because what is their possible advantage over gold? And instead, their advantage was they were this big interlinked global ledger that could move around, and gold couldn't keep up. And so gold got rendered to just being a savings asset, for the most part, and a still a saleable, global asset, but not that quick medium of exchange that you have with fiat. And I think what Bitcoin essentially does is it says, okay, here's something that moves at the speed of fiat, but has the scarcity of gold, at least in the supply inflation rate sense. And so you have, I think, a reasonable shot at something where people can actually hold on to the underlying. They can self-custody the underlying. They can move around the underlying globally without relying on that counterparty trust.
If I may, I agree.
I do agree with George's prior point about how fiat didn't replace gold necessarily in a voluntary way. People didn't self-select for it and then push gold away. However, I would, and this ties into your question, I would point out that, people freely accepted using banknotes when they thought they were redeemable for gold, right? So it's not that they were forced to use that. Basically, they came in and they solved an actual problem, including free banking. Like basically, that a private entity would collect gold, issue banknotes, perform banking services, and that would essentially solve some of the, the shortcomings that gold has. And the essentially problem is that because you had that mismatch between the gold's proper like store of value characteristics, whereas it's not very fast, it's not very divisible, and it got centralized. Because of that, it essentially allowed for a massive rug pull. So basically, all that gold centralizes, and then it's all in the banks, and then the governments can come in, and there's only a few honeypots to go after. Basically, they essentially then control all the gold, and then they can say, okay, now we're going to have these standardized banknotes, and then, oh, by the way, they're not redeemed for gold anymore. Basically, it's this series of rug pulls that leads to all the gold being centralized and detached from the currency. And so you still had people desiring something that moved faster that they thought was redeemable. And just the challenge was that because of that mismatch, they were basically they were short on that promise. And so whereas something like Bitcoin, because it's actually the bearer asset that you can hold, it's harder to get rug pulled. Now there still are questions around the long-term network. Is it gonna remain, say, resistant to 51% censorship attacks by miners? What happens if governments do try to ban it? We do have some, kind of points on that. For example, in Nigeria, it's not the strongest currency in the world. A lot of people prefer dollars. They prefer Bitcoin. They prefer stable coins, whatever the case may be. And so what Nigeria did was they didn't ban it, but they cut it off from their fiat system. They said, okay, banks can't send money to crypto exchanges. Yeah. And yet you still have a very, very high adoption of Bitcoin and other digital assets like stable coins in Nigeria. And that's because, when there's a strong desire for it, people are able to more easily go around it. And the cost of enforcement, it's very easy for a government to enforce things on banks. You just tell the banks in the country, you can't do X, Y, Z. And of course, every single one complies. Whereas if you're trying to enforce things at the individual level, that's a much more costly form of enforcement. Okay. And so, yeah. So I don't think that's an area where George and I are going to disagree much. So I agree with everything he said. One caveat I'd point out is that when you ask if something's a preferable form of money, you have to analyze the question from both the issuer's perspective and the user's perspective, right? So I can see why governments want to issue central bank digital currencies. It gives them greater surveillance capabilities. They can program different interest rates more easily for different regions or different groups of people, and they can freeze people's money. I mean, there's all sorts of things that they can do if they have digital retail money. Whereas from a user perspective, cash is, physical cash especially is a private medium of exchange. It's one of the relatively few forms of transactional privacy that people still have, which is actually a pretty significant reason why governments would prefer to minimize it. And so from a user's perspective, you would generally prefer to have your choice of money. So you'd prefer to have, maybe there's some contexts you want private money. There's other times you want the convenience of super fast digital money. Yeah. And that people could pick the type of money that most suits what they're after. And it also depends on where you are in the world. I mean, for a lot of people, privacy is a bad word, but I mean, something like 50% of countries in the world are classified as authoritarian in some way. And there's some significant degree of curtailment of individual liberties, arbitrary bank freezes, not very strong rule of law, right? And so, in many parts of the world, the right to transact is essentially a human right, or even in the the UN, one of the articles is right to privacy. We also have, in the US, there's, the amendment, basically protection against arbitrary searches and seizures. Basically, privacy is one of those things that goes back pretty far, that there's something people want reasonable degrees of it. And cash is one that people still have in that regard. Well, non-fungible basically means it's non-fungible, whereas Bitcoin is pretty fungible. There's actually different degrees of fungibility, right? So for example, individual UTXOs are moderately fungible. They're still somewhat trackable. The way I would describe it, I think that's a way to describe it for people that generally promote other blockchains. And the challenge there is that NFTs are generally running on blockchains that are pretty centralized. And so in many ways, I would describe a lot of those systems, including the NFTs that run on them, as a form of fiat, essentially, that you're still using a rather centralized ledger. So I would say that I would not describe Bitcoin as an NFT. Instead, I would describe it as, out of all the cryptocurrencies that exist, it's the one that is most optimized for true decentralization. I would say not significantly. And if anything, over the past couple of years, we've had a divergence between Bitcoin and the broader crypto space, right? So for example, you see that the CEO of Coinbase has like a .eth on his Twitter handle, for example. You've seen kind of this emergence of Bitcoin only companies, right? So ones that are just, instead of going onto an exchange, it's kind of a casino environment. You trade multiple different cryptos. Most of them lose their value significantly over the long term, especially in Bitcoin terms. Instead, you've had this kind of rise of a separate Bitcoin only ecosystem. And obviously on the exchanges, you still have overlaps of those Venn diagrams. And so, there are many people in the space that actually view, that are Bitcoin proponents that have a negative view of Coinbase and a negative view of some of these large exchanges. So I would say there's actually quite a divergence between them. But obviously, when you have a bear market in the broad space, that's when you get a lot of layoffs and weaknesses across the whole space. I mean, Coinbase was not laying people off in the raging bull market in Bitcoin and cryptos. They are laying people off now that there's a trial in the market. So in that sense, they're connected. So I think 6 months is almost entirely a question of liquidity, right? So there's basically in the near term, Bitcoin is generally highly correlated to global measures of liquidity. There's a number of ways to do that. So generally when you have, say global M2 denominated in dollars going up, generally Bitcoin is doing pretty well in that environment. And generally it's doing pretty poorly when you have that number either going flat to down, which can either happen because global M2 stopped increasing or because the dollar has strengthened relative to many other currencies. So the way I've been phrasing it to my readers is that I have a very uncertain outlook with, say, a 6-month perspective. But I'm, quite bullish with, say, a 3 to 5 year perspective on the asset, that I think all the structural characteristics are still favorable for its a high likelihood of long-term appreciation, but that, in any sort of 2-quarter period, it's obviously a very volatile asset. It can be shoved around by all sorts of macro forces.